All right, lock in with me. Because what I'm about to walk you through isn't just another trade dispute, another tariff headline, another round of political theatre. What I'm seeing in the data, and I need you to really hear this, is the early structure of an economic fracture that most people are wildly underestimating. And here's the part that should make you sit up. This fracture isn't with China, it's with Canada. The timestamp that changes the conversation, January 2026. Gasoline prices across the American Midwest are up roughly 70 cents per gallon compared to March levels. Automakers are idling production lines. Industrial goods prices are running nearly 1.9% above trend. The cumulative trade damage has already crossed the $30 billion threshold. Now, you've heard these numbers, but I want you to look at them differently. Because when I pulled the sequence of events, when I layered energy flows, supply chain friction, and policy timing on top of each other, something very uncomfortable emerged. This is not a typical trade skirmish. This is economic self-inflicted stress concentrated in the most structurally sensitive parts of the US economy, and I need you to understand why. Let me start with the end game, not the beginning. Before we even get into how this started, I want to show you where this can go if the current trajectory holds. Picture this scenario. Midwest refiners facing constrained access to Canadian heavy crude, diesel inventories tightening, freight costs rising, vehicle prices climbing, agricultural export markets narrowing, border economies slowing, strategic mineral flows redirecting, defense supply dependencies shifting. That's not fear-mongering, that's a mechanical chain reaction. When A moves, B must respond. When B responds, C accelerates. When C accelerates, the system doesn't politely adjust, it lurches. So let's rewind and dissect the plumbing. Block 1. The energy trap. Washington pretended didn't exist. I need you to forget for just a moment the phrase energy independence, because on paper, yes, the United States produces more crude oil than Saudi Arabia, more than Russia. Net petroleum exports often exceed imports. But here's what I found when I went deeper into refinery configurations and crude quality data. Energy independence is not about volume, it's about compatibility, heavy versus light, why chemistry matters more than politics. American refineries, particularly in the Midwest and Rocky Mountain regions, were engineered over decades to process heavy, sour crude. Dense, high sulfur, difficult to refine, but perfect for facilities built with cokers and desulfurization units designed specifically for that chemistry. The crude we produce domestically, predominantly light sweet crude from the Permian Basin and Bakken Formation. Different viscosity, different sulfur content, different yield profile. You can't just swap one for the other like changing brands of gasoline. The equipment, throughput economics, and product slates don't align, and this is where the dependency becomes real. The number nobody likes to say out loud, roughly 60% of US crude oil imports still originate from Canada. More critically, Midwest refineries import approximately 4 million barrels per day of Canadian heavy crude, representing about 70% of the crude slate in that region. 70%. That's not optional supply. That's foundational input. We'll just redirect domestic oil. No, we won't. Here's the mechanical constraint. Pipeline infrastructure from Canada flows south. There is no large-scale, immediately deployable system designed to reverse flows and send Texas-like crude efficiently into Midwest heavy-optimized refineries. Could we reconfigure? Yes, over years, with billions in capital expenditure, while facilities operate suboptimally or sit idle, which means in the real world, not the political world, short-term substitution is technologically constrained. Then came the tariffs. When the US imposed tariffs on Canadian energy, the assumption, and I've reviewed speeches, press briefings, policy notes, was straightforward. Canada needs access to the US market. Canada will absorb the cost. Canada will comply. Even Donald Trump framed the leverage bluntly, at one point suggesting Canada could become the 51st state to avoid tariffs. It played well domestically, but here's what Washington missed. The structural escape hatch. Trans Mountain Expansion, May 2024. The Trans Mountain Expansion project came online. For the first time, Canadian crude had expanded direct access to Pacific export routes. Translation: Canada was no longer trapped. They could redirect barrels to Asia, and they did. By 2025, China was purchasing record volumes of Canadian oil, particularly heavy grades well-suited to Chinese refineries. So instead of absorbing the tariff, Canada diversified the buyer base. Now, look at your gas pump. When I tracked regional fuel price responses post-tariff, the impact was clear. Midwest gasoline prices rose between 30 and 70 cents per gallon. Diesel followed. Freight costs increased. Input costs rippled outward. Because energy is not just a consumer commodity, it's a universal production cost. The Goldman Sachs estimate that shouldn't be ignored. Goldman Sachs modeled the effect of a 10% tariff on all U.S. crude imports. Estimated annual cost to American households, $22 billion, roughly $170 per household per year, before escalation, before retaliation, before supply constraints, the darker scenario. Now let's talk about something I'm watching very closely. If Canada were to restrict energy exports, a possibility Mark Carney has signaled in strategic language, the issue isn't price, it's availability, diesel shortages, commercial trucking disruptions, logistics delays, because you can pay more for fuel, you can't operate without it. Let me be blunt, we cannot replace Canadian heavy crude with domestic light crude overnight. Not politically, not economically, not technologically. This is not leverage, this is revealed dependency, and markets are starting to price that reality. Block 2. The death by friction. How supply chains actually break now. I need you to shift from energy to manufacturing, because this is where people tend to dramatically underestimate compounding effects. Let's use a familiar symbol. The Ford F-150, America's best-selling vehicle for over 4 decades. The myth of American-made. When I mapped component sourcing and border crossings, here's what emerged. A single automotive part can cross the US-Canada border 7 times before final assembly. 7. Engine blocks cast in Canada, machined in Michigan, sent back for integration, returned again. This is not inefficiency, this is specialization across an integrated North American production system. USMCA, the invisible backbone. Under the USMCA framework, this cross-border flow operated largely duty-free, minimal friction, predictable logistics, stable cost structures. Effectively, North America functioned as a single manufacturing platform. Then tariffs entered the system. 25% tariffs on automotive imports, temporary exemptions, partial reinstatements, policy uncertainty layered on top of cost shocks. And what happened next was textbook. Institutional behavior tells the truth. Stellantis halted production at Windsor Assembly. General Motors paused BrightDrop EV van lines. Ford warned of potential price increases. These are not political reactions. These are operational responses to margin compression and cost volatility. The price data confirms it. April 2025. Average new vehicle price, $48,699, up 2.5% in a single month. J.D. Power projections are a 5% increase by year-end. And here's the range analysts modeled for tariff-exposed vehicles, $2,000 to $15,000 in additional cost. That's not rounding error, that's affordability stress. It doesn't stop at cars. Industrial goods prices, running roughly 1.9% above trend by summer 2025. Appliances, machinery, electronics, because tariffs don't stay in trade policy, they migrate into CPI components. Pass-through is relentless. Companies typically pass 60–80% of tariff costs to consumers, meaning every refrigerator, every washing machine, every aluminum-intensive product carries embedded policy tax. Steel and aluminum, the hidden multipliers. 25% tariffs on steel and aluminum increased input costs across construction, automotive infrastructure. Durable goods monthly duties on Canadian automotive components alone, $400 million. That's sustained cost pressure, not a one-time hit. The strategic miscalculation. The stated goal, bring manufacturing back to America. But here's what I need you to understand about industrial reality. You can't relocate complex production systems on political timelines. New assembly plant build-out, 18 months to 3+ years. Workforce training, years. Supplier ecosystem development, longer. So what happens in the interim? Higher prices, production pauses, margin stress, layoffs. And a question corporate boards begin asking quietly: should our next supply chain expansion avoid North America altogether? That's not rhetoric, that's capital allocation logic. Block 3. The pivot that should make strategists nervous. Now we need to talk geopolitics, because this is where the second-order effects become strategically explosive. January 16, 2026, the visit. Mark Carney becomes the first Canadian Prime Minister in nearly a decade to visit Beijing. But I want you to hear this correctly. He didn't go to complain. He went to transact. The agreements that emerged: strategic partnership announcements, trade barrier reductions, tariff adjustments. Canada allowing up to 49,000 Chinese EVs annually at a 6.1% tariff rate. China reducing tariffs on Canadian canola from 85% to sub 15%. Canada targeting a 50% export increase to China by 2030. Let that sink in. Your closest ally, your largest trading partner, actively diversifying toward your primary strategic rival. The statement that shocked Washington: Carney publicly describing China as a more predictable trading partner than the United States. This is the same leader who previously labeled China Canada's biggest security threat. So what changed? Not ideology, incentives, dependency, recalibration. Canada exports roughly 80% of goods to the US. That concentration created vulnerability once trade became weaponized. Rational response? Diversify risk. The North American entry point problem. While the US maintains 100% tariffs on Chinese EVs, Canada lowers barriers dramatically. Result: Chinese vehicles, batteries, and components flow into Canada. Canada becomes a partial gateway into North American markets. Critical minerals. The quiet battlefield. Canada holds vast reserves of lithium, nickel, cobalt, uranium, rare earth elements. These are not abstract resources. They are inputs for defense systems, batteries, semiconductors, green energy infrastructure, the trade value that matters. Bilateral US-Canada, critical minerals trade, $95.6 billion. Nearly $100 billion in strategic materials moving across that border. Now imagine those flows increasingly redirected toward Asia. This is the irony. I need you to see. Tariffs intended to discipline Canada incentivized Canada to deepen economic ties with China, which means we may be accelerating the transfer of strategically vital resources into rival supply chains. The geographic shift. For decades, US defense doctrine assumed a secure northern flank. Canada as part of Fortress America. Now, Chinese capital in Canadian infrastructure. Chinese vehicles in Canadian markets, Canadian trade diversification toward Asia and Europe. Encirclement narratives once focused south. Now there's movement north. The nightmare scenario isn't betrayal, it's misalignment created by policy shock. We didn't lose an ally, we destabilized alignment incentives. Block 4. The casualties that don't show up in headlines. Let's bring this down from macro to human scale, because this is where economic policy stops being theoretical. American farmers. First-order damage. 2024, Canada, China, Mexico purchased $91 billion in US agricultural goods. All three later imposed retaliatory tariffs. Canada's March 2025 retaliation: 25% tariffs on $29.8 billion in US goods, including $5.5 billion in agriculture. Targeted products: beef, dairy, pork, fruit chosen strategically, items Canada could source elsewhere. The export data turned downward. March-June 2025, US agricultural exports to Canada declined by $440 million year over year. That's not noise, that's income compression. The double squeeze: farmers paying more for equipment, inputs, fuel, while receiving less for soybeans, corn, beef, dairy, because they are price takers in global commodity markets. Border economies. The silent contraction: cross-border traffic down 20 to 27% depending on state. Tourism declines, retail losses, hospitality damage. Nevada, 200,000 plus fewer Canadian trips. Border towns, sales declines of 10 to 25%. Hotels emptying, restaurants are closing. And here's what matters politically. These impacts concentrated heavily in small towns and non-coastal regions, not abstract GDP, real livelihoods. Block 5, July 2026. The inflection point you should be watching. Now we arrive at the structural trigger, July 1st, 2026. Mandatory USMCA joint review, 3 paths extension, stability through 2042, renegotiation, uncertainty, friction, volatility, non-extension, annual reviews, potential termination policy, signaling is not reassuring, US trade. Representative statements indicating no automatic rubber stamp. Canada and Mexico preparing counterpositions. Translation: negotiation risk is real. Collapse scenario mechanics. If USMCA fails, reversion to WTO default tariffs, dissolution of single North American market, supply chain realignment, increased trade friction, investment hesitation, Canada's diversification, already underway, CPTPP access to Asia, CETA access to EU security partnership with EU defense cooperation with South Korea, parallel architecture development, reduced US centrality. Now let's talk about what this means for you, because analysis without positioning is just commentary. The risk framework I'm using, when I model this environment, I categorize exposures into 3 buckets. 1. Inflationary pressure channels, energy costs, goods pass-through, input price volatility. 2. Supply chain fragility channels, automotive industrial goods, semiconductors, defense inputs. 3. Geopolitical realignment channels, critical minerals, energy flows, trade blocks. The asymmetric considerations. I'm not telling you what to buy, I'm telling you what I'm watching. Hard asset sensitivity environments. With policy-driven supply constraints historically support energy producers, select commodities, physical precious metals, not ETFs alone, structure matters, pricing power businesses, companies able to pass through costs without destroying demand. Look for high margins, essential demand, low substitution risk, geographic revenue diversification firms, not overly dependent on single region trade stability. Indicators I need you to track with me, because this story is still unfolding. Watch. Canadian crude export volumes to Asia, Midwest diesel inventories, USMCA negotiation rhetoric and drafts, industrial goods, CPI components, cross-border traffic and tourism data, critical mineral trade flows. Let me leave you with the central question. Is this a temporary negotiation shock, or the early stage of a structural North American economic decoupling? Because those are radically different futures. And here's what I want from you. Do you believe cooler heads prevail in July 2026? Or are we witnessing the slow fracture of the most successful regional trade bloc in modern history? Think about your portfolio. Think about your cost of living. Think about your exposure to energy, manufacturing, and consumer pricing pressure. And then ask yourself, are you positioned for stability or for volatility? I'm watching this closely. You should be too.